Good afternoon and welcome to this Yellowstone Advisory webinar with Capita PLC. We're delighted to have with us today Adolfo Hernandez, Chief Executive Officer, and Stephanie Little, Deputy Director of Investor Relations. I'd now like to hand over to Stephanie Little to start today's presentation.
Thank you very much for the introduction. As Alex has just said, I'm Stephanie Little and I'm joined here by Adolfo Hernandez, CEO of Capita. We last met with our retail shareholder population back in March when Adolfo was seven weeks into the job.
Indeed.
Since then, we've done a Capital Markets Day. We have announced the disposal of Capita One, and we've also done our half-year results. So there's been a lot going on in that time. In today's presentation, we're going to cover the H1 results, the outlook for 2024 and our strategic priorities as we move forward. The way that we're going to split the presentation is we're going to do a short summary of, as I've said, the H1 results and our strategic priorities, and then we're dedicating quite a lot of time to Q&A. As Alex said, we've had quite a few questions through, so we want to make sure that we can get through as many of those as possible. I think it's fair to say there is a lot going on. We are excited as we move into the latter stages of this year and into 2025. As usual, I'm just going to refer you to our usual disclaimer, and then I'm going to hand over to Adolfo, who will talk you through our strategic themes.
Thank you, Steph, and thank you everyone for finding the time today to come and listen to what we have to say. I know by the call, many of you have been patient shareholders, so hopefully this additional communication will help you understanding what is it that we're dealing with, what are we doing, most importantly, why are we doing it, and how are we going to get it done to get the right results. From the Capital Markets Day, and probably many of you might have listened to it back in June, but there was one slide that I found to be powerful because it sort of said a lot of the message was this one of the better themes. Because this is what we're trying to do. We're trying to build a better Capita. Capita, as I have found in my 7.5 months in charge, as I've gone around meeting customers and meeting employees and seeing down on the ground, what is it that we do day in and day out? We do a lot of good work. We really matter to society. We really support citizens, governments, telecoms companies. We really enable a lot of the work that utilities, energy companies have been doing in difficult times. What we do in financial services, supporting vulnerable customers, what we do really, really matters. However, we have fallen short when translating that great work into financial returns. And I keep saying to my team, it's my responsibility, it's my obligation, and it is my mandate to help Capita find that path where we can deliver that financial return by building a better company. And so easier said than done. How are we going to do that? Through these 4 vectors. Number one, finding better efficiencies and more efficiencies. We can't possibly spend the amount of money we spend to generate the revenue that we generate. We've had to find ways to automate, to just delayer, to be much better at executing through automation, through the use of technology, through streamlining organizations, everything that we do. Technology into everything that we do. How we do it internally, how we run Capita, how we take advantage of technology to make us a leaner organization, a more agile organization, a more efficient organization, but also include more technology in our value propositions because our customers are right now looking at outcomes that they need help delivering, and most of those outcomes can be advanced by technology significantly. We also have to get better at delivery. We consistently deliver around 95%, and while that is very good, I think we have to do better. We have to do much better and get closer to 100%. We can't hardly get to 100% in a complex project business, but we have to up our game and we have to raise our standards further to make sure that we don't sign the wrong projects. And then when we sign the right projects, we actually deliver them on time, on budget, and on quality. And then as a result of that, we will deliver a better company. It will be a better company for our colleagues to continue developing their careers. It will be a more attractive company for people to join. It will be a better company for our customers to do business with, because they'll feel more reassured, not only about the present, but also about the future. And also, importantly, a better company for current and potential future shareholders in the future want to get a return on that investment. So that's the mandate. That's what we're trying to do. And what we're going to try to do here is a shorter version of the last couple of updates to tell you where we're making progress and the type of progress we're making. But before we do that, where are we? What are we going to try to get? Well, I think in an initial phase, I think about, first of all, it's about efficiencies. We need to get efficiencies into the company. We have to reduce cost. We have to find the space, and we have to create the space so that we can do all these great things in a better way. So that means getting smaller initially, and as a result, we will leverage those better efficiencies to improve our EBIT margin to 6 to 8%, and we make good progress, but there is a lot more work to do. We have to improve our free cash flow. We have to become a positive free cash flow, but in a first step, we need to get better at converting profit into cash. So we believe over the medium term, we should be able to get it to 65 to 75%. And then once we've done all of those very foundational things, which is just making sure that we are profitable and we get profit growth, and that we are better at managing, generating cash flows, then it will be about growth, and we should be able to get to low mid-single digit growth, sustainable in that final phase of the project. So where are we? So at the end of June, we delivered a 45% improvement in operating margin. I said a good step in the right direction, but there is still a lot of work to do. You might remember when we talked, we had announced back in July 2023 that we were going to do 40 million. Then the company announced that we were going to do 60. Then I joined a couple of months after that and said, no, we are going to do 160 million. We reported that we already delivered 100 million of those annualized 160. And that was as of June 30th. We needed to reestablish the relationship with the hyperscalers. We needed to move from being good customers, buying their technology, to actually being partners and be able to launch solutions with them and co-create solutions for the market. We've been able to launch solutions in the space, particularly in the generative AI space around the Agent Suite, but also Capita Contact. Capita Contact released in June, Agent Suite released in July. We kicked on a really aggressive culture transformation program. You can't get everything done that we want to do without changing and evolving the culture in Capita. There's some fantastic things in the culture, but there are also a number of things in the culture that were getting in the way, that are holding us down, and that we are working aggressively to transform. We also agreed to sell Capita One. Since then, we've completed that sale earlier in the month, and we got net proceeds of 180 million. And I'll talk more about that manage for value bucket a little bit later. And we see that with information we have at the moment and trading, we are on track to deliver the full year operating margin, profit, and free cash flow expectation. So far, just a good first step in the right direction that we announced at Capital Markets Day. So Steph, quickly run us through the financial highlights, and then I'll pick it up from there again.
Of course, thank you very much. So yes, as I said at the half year, our revenue declined by 9.3% as a result of previously announced contract handbacks, losses, and the non-recurrence of one-offs last year that we had in experience, which we talked about at the time. As Adolfo's just said, our operating margin improved 45% as we saw the benefit from the ongoing cost reduction programme that we've talked to, which more than offset the H1 23 one-off benefits that we had in the prior year. As expected, we saw a reduced level of DI releases in the period, which has improved our operating cash flow, and our free cash outflow was 52 million, which again was in line with expectations, benefiting from the reduction in our pension deficit contributions and the lower cash costs from the cyber incident, which was then offset by the costs to deliver the cost reduction programmes, which will improve our margin going forwards. If I look at our sales pipeline, as we've talked to, and as Adolfo talked to in terms of our priorities, we're focusing on ensuring that we are price competitive and that we are bidding all contracts at an appropriate margin. And as such, we saw a reduction in our TCV down to 0.9 billion sold in the first half, down from 1.3 in the prior year. You'll also have seen today that we've just announced the extension of the DCC renewal, which is worth up to 135 million over 2 years. Our renewal rate, as you can see from the slide, remains really, really good at 95% and was up slightly from the prior year. But there is clearly work to do in the new and expanded scope area, which will come as we become more price competitive, which will help us grow our revenue kind of as we move into the longer term. Our 2025 pipeline is looking really, really strong and is the highest it's been in the same period for many years. We've got some really good opportunities in there with TfL, with the Home Office and with the Ministry of Defence, just to name a few. Then if I look at our full year outlook, as Adolfo said, we've reaffirmed our full year outlook and we have a positive outlook for the full year. While we do anticipate that our overall revenue will reduce on a low to mid-single-digit % reduction, we're expecting to see a modest improvement in the operating margin as we see the continued benefits from the cost reduction programme. As we've guided to in the past, we expect our free cash outflow to be between 90 to 110 million, which I should point out includes 50 million of costs related to the cost reduction programme. And as I know you have all seen at the start of this month, we completed on the Capita 1 disposal, which means we'll have net minimal financial debt at the end of the year. And in terms of our property lease portfolio, that's also clearly an area of focus with IFRS 16 and the impact that has on our balance sheet. So we're expecting to see a continued reduction in our lease debt as we rationalise our property portfolio, which is an area of focus at the moment and will be kind of as we look going forwards. I will hand over now to Adolfo to talk you through some more slides from the CMD.
All right. Yeah, this is what I call the 6 months project into one slide. So let me see if I can do this slide justice, because I think it's a really important slide. There was a project that we started just before I joined, where we asked strategy consulting company, OC&C strategy consultants, to help us look and understand Capita, not Capita out, but to understand Capita from the market in. Right? I really wanted to get a view from current, past customers who had affected us, colleagues, competitors, really trying to understand market players, analysts, where was the company, and then walk our way into what are we hearing, what is it that they're saying, and then finding out what capabilities did we have in the company, which capabilities were good, and then do double click and workshop every single one of the capabilities and look at where do we win often, where do we win well, where do we deliver well once we've won them, where do we have a strong competitive differentiation that is going to be sustainable, what is the market doing in that space, what's the margin profile associated with those. All of these things, and quite a complex analysis, north of 50 service lines and capabilities we had to announce. And then we just bucketized them, right? Because then we had to say, okay, let's just put one bucket, which is circa 45% of our last year's revenue, the star positions, those places where we do well, right? You see Capita at its best. And financially, we deliver good financial value, and we deliver good customer value, and we're known for doing it well. So there is a question just doing more of that. And some example, it's some of the work we do for the Royal Navy, for example, on training modernization. You've got the low emission work that we do in London. You might have been seeing quite a lot of news recently in the news around the fire prevention and response and some of the really big innovations we do in that space, or the great work we do in pension administration and a number of others. So that was a good bucket. So just do more of it because we're doing it well. Then there was a medium bucket, which was transformation potential, right? So roughly a third of what we do. They could be good propositions. They could be good propositions for us, but we're not doing them as well as we should. Either we didn't invest enough, or we didn't differentiate enough, or we didn't put enough technology or the right technology, or we missed something over the last few years. And that's led to an okay-ish position. But we do believe there is a good opportunity for them. They are in the right space for us. And one example of that would be potentially what we do in contact center. Right? It's a good market to be in. If anything, the whole market around customer service is of an increasing importance as brands look to differentiate. Citizen service is a critical area of interest for governments. But how we've been doing it has led us to lose a number of contracts and not being able to compete in the way we should have. So there we've got a transformative agenda, largely around hyperscalers, where we believe we should be able to get through automation, through tech enablement, and through more repeatability of offerings, A, more competitive offering, and B, easier to sell and better to deliver. So very hopeful that we should be able to start moving some of that from transformation over to Star over the next periods. And then we have a final bucket, managed for value, roughly a quarter of our last year's revenue. It's a little bit of a mixed bag, where we have to do some transformational stuff. And in many areas is transformational because it's just not the right thing for us to be in. Like, for example, Capita One was a good business, but it's a horizontal software business that, so there's a little bit of offsets with our services capability. It doesn't build on hyperscalers. It was just in the wrong place. But that was a little bit of an exception. The rest are propositions that have to be present in the Capita value proposition, but maybe we can deliver them differently. Maybe we need to optimize delivery radically. Maybe we need to partner with somebody, and as I said, some of them need radical transformation or renegotiations. And that's those we're working on. Some of them you know, this has been standing there for a while, like the closed book, like on pension type work. And you know, we talked about standalone software, so you can read there, Capita One. But it helps management, and it helps us tremendously, hopefully, as we do these dialogues with you, to sort of understand what is it that we do daily, how are we doing it daily, and really look at the world through the lens of this and making sure that things are getting the right level of attention and focus where we are. So, as I said earlier, efficiencies was going to be a very important part of the first phase. I like to describe this transformation as a multi-step transformation. I like to say the first step is finding the way to create the space to do all the good stuff. So quick wins to fund the journey. And that's the phase where we're in today. Not exclusively, but a lot of what we do is about reducing reducing that overhead, reducing the cost base so that we can have the space to be in the right place financially, but also to invest so that we can fix the basics, because these basics are what's going to give us the scalability, is what's going to give us the sustainable differentiation, and then to also invest into building the future. And I've been very clear that I don't want to say 2024 is the year of cost takeout, 2025 the year of fixing the basics, and 2026 the year of building the future, because that would be wrong. For example, the July Gen AI offerings are very much about building the future, and we're doing them in July 2024. But as a large, we're doing more of funding the journey in 2024. So what are we doing with that respect? So we said we up from 40 to 60 to 160. We've delivered already 100 as of June. Obviously, we've made progress since. And a lot of that has come from organization simplification, delayering, just sort of streamlining things. We still need to make the company more agile. We need to make the company faster. We need to make sure that, you know, we are more effective. So that work continues, and we continue through the second half of the year or the remaining Q4 and into the first half. We're not going to let go because the opportunity is big and it needs to be addressed. On fix up the basics, I think about just really looking at end-to-end processes, looking at offshoring, nearshoring, right-shoring, deploying technology, improving management information, dashboards, access to information, things that will enable us to make better business decisions quicker and get into better businesses and more often, because we have an agile and well-informed business. And then processes and data flows that allow us to prevent wreck projects or delivery issues and go back to one of our priorities of better deliveries. That will come through those basics. And then building the future is about being able to intercept the growth vectors that are very technology rich and where we should play and really monetize and intercept those faster growing vectors from 26 onward. So you're going to see spaces like digital virtual wards to support on healthcare, or you're going to see more automated call centers born in the cloud, or you're going to see more IT solutions management built in the cloud on the back of automated platforms for the like of ServiceNow, or building customer 360 views, as many councils are starting to do, many utilities, many telco companies are starting to do on the back of leading CRM vendors like Salesforce. So there is that capability that we are going to be redirecting. The slide should say reinvest up to 50 million in the business, and it should say also only when we have taken the 160 million out. So we just earmarking that investment capability for the future, but it's not something that we're going to do until we have significantly reduced our cost base. On the technology front, without wanting to sort of get too crazy, why is this good for us? I get this question asked a lot. Are you sure you want to do this? I think it's really important because it creates value for customers in a way that they couldn't get on their own from a pure play services company like Capita or a pure play technology company like a hyperscaler. What customers need is a solution to their problem. They need an outcome being delivered. And that outcome being delivered is a collection of the best technology, it's a collection of some integration, but it's also a combination of a good understanding of the business processes, good understanding of how to manage the people that go into this, how to onboard them or recruit them, onboard them, train them, manage them, how to deliver the outcome, how to use the technology, which technology to use, and how to ensure that the trust that customers have on us delivering the business process can be extended into the tech. We couldn't do it on our own, and I think you just have to look at the last few years to see why, that it didn't work. And most of the hyperscalers have great technology, but they lack that final mile, and this is really where we come together. If you bring it together, it's going to help us improve the offerings. We're going to improve our win rate. We're going to be taking cost out of our offerings, so it's just going to make us more competitive. And because we are moving to a world that is on the cloud, where you pay per use, there is no upfront capital expenditure. So you effectively start paying when you use it, and you're using it because the customer is using it, hence the revenue is already in. So you align the cost, which by the way, it's not CapEx, it's more variable cost, and the variable cost is very well aligned to revenue. And overall, it's just going to give us an ability to give efficiencies on our solutions. And some of the value will be shared with the customer, some of the value will be with us, which is great. This is a market that is moving at a pace. It's growing, and the investment these hyperscalers are making is huge. You know, whether it's in data center infrastructure, whether it's in GPUs, whether it's in Gen AI, whether it's in LLM models. I mean, there's collectively they are in close to sort of trillion. Don't want to be there. I'd rather us to be at the very top, bring our capabilities on top of what they're doing, bring that sort of Capita veneer that sits on top and integrates it and deliver and manage process as we normally do. Products operational that didn't exist until a few months ago. You got Capita Accelerate, and there's something that we have deployed for the Army. It's natural language processing that helps process and understand very quickly complex medical records of potential recruits. Capita Contact is something that we developed with Amazon and AWS on top of the Connect platform, which is a call center on the cloud managed by Capita. Capita Digital Pensions. This is an extension of our well-known platform for pensions administrations being co-developed with Microsoft on the back of the dynamic CRM platform. And the Capita Agent Suite, again, is built on a number of technologies. First version is built on AWS, but it's platform agnostic and one that we can deploy to get efficiency and productivity into our agents and also into management. So if this is what we've been able to do in a few months, think about the amount of things we will be able to bring to market in the next year and how many of these capabilities will be discussed and sold and in production with our customers. So very, very excited about this and having found a good place for us to be in this value chain to participate in the technology race without having to be a technology company. We are going to be just adding that veneer of process expertise, which is something that people know we have, on top of the technology innovations that these great companies are building. So I'm quite excited about the prospects here. In terms of case studies, so I won't get into the details there, you can read them. But I think the one to see there is to see the benefits, right? Whether it's how you reduce, from 7 to 10 days on board to complex queries to 2 to 3 days. How we deploy Gen AI on the agent suite, we can reduce the average handling time by more than 20%. So those are meaningful numbers. So the meaningful numbers for one person, for one agent, for one advisor. Very meaningful when you do it for 1,000 agents for a customer. Very, very meaningful when you get to do it for 20,000 agents all over the world. So we have ambitious plans to be rolling this out in second half and accelerating into the totality of our customers in 2025. So excited and already at work in some of our customers. So just that was a very quick flyover of what we're doing, why we're doing it, some of the financials. But I think the investment case, besides the medium-term targets, which you have at the bottom, which we've already covered, are back to what I said at the beginning. This is a company that has strong foundations with customers. What we do matters to our customers. We are making the difference. Our colleagues know what we're doing and they're valued by our customers. We have that expertise. That's a really strong set of foundations. We just need to translate that into the economic value. And this is what we talk about, this self-sufficient strategy through our big focus on efficiency. We're looking at profit expansion and cash generation. And the 3-bucket approach that I described earlier, the more targeted approach to start positions, fixing and transform the middle, and then addressing the management for value will create the capacity to allow us to be more consistent in our go-to-market, leverage the partnerships with the hyperscalers, and then overall be a company out there that is able to bring outcomes based on the latest technologies and make it life a lot easier for customers. There is a lot of work to do, as I keep saying to everybody. There is not a one single bullet. There's a lot of lead bullets in terms of operational efficiencies, in terms of redefining the value propositions, in terms of the hyperscalers and taking cost out. But we know what we need to do. You know, we've done this before, and we're just getting started. But I think the first half was a good, positive first step. Thank you. So with that, I think we go to Q&A.
Yeah, thank you, Stephanie, and thank you, Adolfo, for that presentation and bringing us up to date with progress. We are now going to go to Q&A, and as a reminder, if you'd like to ask a question, please type it into the box at the bottom of your screen, and we will try and cover as many questions as we can in the time available. Let me start off with a couple that came in ahead of time. Could you talk about the bidding process? What's the minimum margin you would accept on new contracts, and where are you having the most success?
It's an excellent question. I wish I could give you like a sort of blanket answer, and they would be very difficult mechanically because every business is very, very different. So, for example, some of the contracts that we have with the government, they are what I call cost plus contracts. So we have to do an open book, and we have to agree what's deemed to be a good margin, an acceptable margin. Obviously, the risk on a cost plus margin contract is very reduced. So there, obviously, flexibility is less. Then we've got other contracts where a lot of what we do is technology based. Maybe not the most modern technology, but it's got technology based. So there we tend to command higher gross margins. And then obviously we make more profit, and you would expect us to be pushing the envelope more there. And, you know, to say, okay, why 10%? Why not 15? Why not 20, 25%? So there we push a lot more. But I think the overall question is when we look at these big deals or any deal really of a certain size, we ask ourselves the question is, how is this deal going to help us with our medium-term ambition of getting to that 6 to 8 EBIT margin? And then we have to look at, okay, what is obviously the price, what is the level of overhead of that division, what is the level of overhead that we have to absorb in the group, what's our ability to take cost out, what do we have planned for that particular area of the business. And we do analyze case by case because the cases, as I've illustrated in two very different cases, are very different. So we look at them, and if we don't see a path for it to be contributive and accretive to that 6 to 8% margin, we either will not bid, or we will bid at a price that we believe is what it takes. And we would tell the customer, we are not pricing to win, we are pricing to deliver. If you want to go for a cheaper option and take the risk, please do that. But this is what we believe is a sustainable pricing and margin. And sometimes we lose it. But we're just being honest. And I think here we're playing the long game. You know, I've been in sales for the best part of 30 years. It's very easy to have 5 minutes of glory and 5 years of tears. I'd just rather just lose a few, initially get the house in order, price right, and just make sure that we got a pipeline of deals and deals in delivery that are going to go there. Obviously, there is a process internally with these things get reviewed, as you would imagine. Smaller deals get reviewed lower in the organization. The biggest deals would come to the CFO and to myself. And then there is a level beyond which as well we need to involve the board. So it's appropriate level of oversight and approvals to do all of these considerations that I just described.
Thank you. Linked question here on contracts. I know you announced a contract win today, but what contract wins have there been in the last 3 months, and have there been any contract wins that you've had that you haven't announced?
Yes, so obviously we had the DCC announcement this morning. Another one that we had at the start of July was the Royal Mail pension, which was a really good one to have in. We've got a really strong pipeline at the moment with a number of opportunities due to close in the second half of this year. There's not been any kind of material ones that we've lost in the last few months, other than those that we previously announced during the half year results.
And there's been some that we have not, maybe I guess they were not RNS material. They were strategic, good contracts to win. So there will be one, I will not name them, but it was a UK-based telecommunications company where we had a problematic contract that we exited. By just applying this logic that we talked about, we exited it end of last year because it wasn't the right thing for us. So the customer went out to tender again. And they sent us the opportunity to retender. So we did retender, but we did retender differently, very differently, using a lot of this technology, using offshoring resources. We just built a more modern offer. And even though we had exited, which sort of creates always a few glitches, right, with the customer, we've ended up winning it again. But now we won it in terms that it's better for the customer than what they had, and is a better deal for us. Probably not RNS material, but it's definitely, for me, it's actually very, very pleased with that because it tells us a lot about what's changing inside Capita.
Okay, thank you. That does sound encouraging. You have split the business into 3 service lines. Within Manage for Value, do you anticipate further disposals, and what businesses are you most likely to exit?
So I wouldn't quite say there's 3 service lines. We do have 2 divisions, and then within each division we have 3 areas. So that would be how it works organizationally. But what I have defined is like the 3 buckets where we look strategically as to what management does with some of these capabilities and some of these contracts. And the 3rd bucket is the Manage for Value that I just referred to. So let me sort of go to the punchline right away. There isn't another Capita One sitting there, right? This was unique. And arguably, I know John, my predecessor, looked at it as, is this something that goes into portfolio back in the day? But it was deemed at the time that let's try it for a little bit longer. And the reason why it sort of was still there is because I think we tried it. It didn't work. It didn't make sense. So that's why it landed there. That's unique. Look at Manage for Value as a bucket of service lines and contracts or components of contracts that we do today that are costing us headaches, money, and overhead. So I think a good way to think about that going forward is, okay, the day we address all of this, we're just going to stop problems rather than make money and get significant proceeds for the rest of the portfolio in that bucket.
Okay, thank you. Could you give us an estimated date to achieve free cash flow positive, and also a date for resumption of dividends, and what criteria will you use to determine when Capita returns to the dividend list?
Yes, so we have said that we will be free cash flow positive from 2025. In terms of an estimated date for dividend resumption, we've not commented on that, as you might expect. At the Capital Markets Day, what we outlined was our capital allocation policy, where we effectively split out the hierarchy in terms of what things need to be in place and what we need to have done to resume dividend payments. We've said that as a hierarchy, investment will come first. So that's the reinvestment of up to 50 million once we've delivered the 160 million of cost savings. And then also ensuring that our leverage is the most optimized position. At that point, we will then look at reintroducing dividend payments. And I realise it may seem a very distant thought, but after that, we would then look at further capital returns above a kind of annual or usual dividend stream.
Thank you. Next question here, again on cash flow. I'm struggling to understand why your cash conversion is so low. Are you doing anything to improve this? And with the businesses you have left going forward, what should we expect in terms of the cash conversion rate to be?
So we've outlined that our medium-term target, as you can see from the slide, is an operating cash conversion of 65 to 75%, which obviously is a big improvement from where we are at the moment. In terms of things that will improve that, that's partly improving the operating margin from the business, but also, as Adolfo has talked to, we are reducing kind of the transformation and upfront spend that we have on a lot of our contracts, where we're using the hyperscalers and, you know, technologies that already exist rather than bespoke building everything ourselves, which what we would see in the past is we'd see a lot of upfront cash costs to deliver a contract to start with, and then you recognise your revenue effectively on a straight line over that period. So you had a really lumpy cash flow over the life. What you will see with our contracts going forward more frequently is that you won't have the big upfront transformation spend, because we're using, as I said, technologies that already exist, which will help smooth the cash flow and give you a more consistent cash flow profile going forwards.
Thank you. With the break on government spending, do you expect any changes in your operating environment? Are you seeing any of that already happening?
Well, obviously, a period of elections and new government ministers and always comes with a disruption. You know, it's just sort of, I guess, stating the obvious. We've also got a budget, you know, coming in soon, so we gotta just wait and see where all the chips fall when all of this is done. But if I was to comment on what we know and the conversations we've had with the government and with different people supporting the government, and we look at the manifesto, if you look at the areas that, at least strategically, are going to be receiving policy support / funding, I think there are areas that are going to be good for us. Right, so obviously there's the focus in defence, right? So this is strategic defence review. I think, you know, we do well, I think, in the defence space. I think we add a lot of value to the forces. I think we are a trusted partner to them, and whether it's recruitment, development, training, and operational readiness of the forces appears to be continuing to be an important priority. Now we have to see the output of that review, but assuming that continues to be a priority, I think that's a good thing for us. If I look at the NHS and sort of the big commentary of the last few weeks around the NHS needing to transform, to really deliver, it's not a question of just more money. I think if you look at sort of the digital transformation and some of the work we're already doing with primary care, some of the ideas we got on the table around virtual wards as a way to expand the reach of hospital staff into people's homes so that we can extend care in modern ways. The kind of work that can be done with the you know, full digitization of medical records, so we're really doing part of it. So I think these are areas that would be supportive. Similarly, you know, if we're really going to go and build homes, a lot of the councils do not have that planning capability to deal with that, and we do provide planning services. So a lot of the components of delivering on those policies are things that we're already doing today, and many of these things are actually in our start positions. So I am excited on that, but we still see the policy, still see the funding. So there is a transition where I think of this parliament. I think this will work well. We just need now to see the strategic reviews completed, policy announced, and enacted ASAP.
Okay, thank you. Next question here. Are you seeing any green shoots yet in the experience division, or is this, in your assessment, more of a 2025 story once rate cuts take hold?
I am seeing green shoots that will have an impact in 2025. I think I'll just sort of, it's not either or, it's both. You know, it's one of the examples we talked about, Agent Suite deployed in a particular customer. You know, I have seen how impactful it was on week 1. And then I saw how easy it was to make it more impactful for week 2. And then I've seen how easy it's been to make it even more impactful for month 2. So as I see this, obviously it's still small, but I can see as we accelerate this deployment across more of the CE customer base, you start putting all of these incremental improvements, and they actually start adding to a lot. But that's more something to start seeing in 2025. But the green shoots and the proof points for us operationally are here, but operational improvement always precedes financial improvements, unfortunately.
Okay, thank you. Can you give an update on the data breach and Bearing's recent class action?
Let me just sort of give you two-part answer. Sort of on the data breach, there's nothing to report as such. This was, we've been going through all the motions, and I think first of all was getting to the bottom of what happened. And the third one was working with the affected entities, people, companies, and just put all the support that was required. That was something that was done last year. The company had already embarked on a cyber readiness improvement plan, like any other company. Obviously, cyber had just been something that's been on the agenda for a while, and Capita had started before cyber, and Capita had already started on that journey before I arrived. It is true that we have accelerated it. It is true that we have continued to raise the bar, and that has sort of continued, and we're working with the authorities. And yeah, just nothing else to report. On the bearings, obviously, as you can imagine, there's obviously, yes, a little bit of noise there, but it would be inappropriate for me to sort of comment on any open cases, potential cases. There isn't anything at the moment that it's worth commenting on.
Okay, thank you. We've had a couple of questions on the Capita One disposal. I think this one probably sums it up. Looking at, are the high interest rate US private placement notes callable early? And if yes, and assuming cash generation hits your target of 65 to 75% run rate, could some of the cash from the Capita One sale proceeds be put to use to redeem some of that high cost debt early?
Yeah, so what we said is that the Capita One disposal proceeds clearly provide us optionality. Very true that the PPNs that we took on last year were at a higher interest rate. So we're looking at all options on the table to improve kind of the leverage position and the interest cost going forwards. Clearly, bringing that down and improving our free cash flow in 25 is the priority going forwards.
Thank you. Let me bring the next question up here. Could you comment on the number of buildings and staff you now have and the near-term estimates?
Was that building? Sorry.
Buildings, yeah.
I don't know the number off the top of my head.
No, neither do I. I know we sort of don't own as such. The vast majority is leases. We work down the number significantly. We can provide the exact number of what we've got, and we got planned to either exit leases or transform leases, as in down, negotiate. One thing that I think is important, unlike other companies, we are going to continue on a virtual first policy. There's merits for all sorts of approaches, but we are discovering and talking to our colleagues and also talking to our customers that a mix where virtual first is the norm. It's not everywhere, but is the norm, is the average. It's working the best. It's giving us a good ability to balance work-life balance with our colleagues. Tools that we have now in place make sure that we can track productivity. It doesn't matter where people are, because it's a matter of task performed, and we got a pretty good sight of that. It's allowing us to level up as well, and we're able to hire in multiple parts of the country and optimize on multiple levels. We're still having a good footprint, so people can come together regularly when it's required for projects, when it's required for customer interactions, when it's required for case resolutions. But this virtual first has been highly appreciated. We're hearing from customers that it works well when there are concerns, so that we see that we need to sort of do more physical stuff. We also do office, and we got fully fledged call centers with people in there. But it's for a vast part of the Capita population that is not required, and we believe that's going to be a very attractive value proposition for our employees, which is also going to be financially positive for us.
Thank you. Got a question here on the sales pipeline. Can you comment on the unweighted sales pipeline increase in 2025? Are the new product offerings addressing a larger market?
Yes, yes, there are. Obviously, you always have also some large projects, but those large projects are being built on a significant level of technology components. So some of the solutions I discussed before open up new markets, new opportunities. And what they're also doing is they're allowing us to see opportunities earlier that we wouldn't normally see. You would normally only see some of these opportunities when it got to the services end, whereas now we can sort of look at the opportunity in its exception. And then the other thing that we're doing now through the work with the hyperscalers, we're actually now sharing pipeline, sharing opportunities, and that has increased our visibility as to what's in the market, because they do have a lot more feet on the street than us. So certainly technology has played a role.
Thank you. Sort of a related question to this. Are you at an advanced stage of securing any new big deal business wins or contract extensions that you anticipate being able to call over the next 3 to 4 months?
Well, we got one today. But yes, I would expect us to be able to say about others.
Excellent. Couple of questions here. They're asking the same question, really. Please, can you comment on any other planned divestments?
There isn't anything planned.
Thank you. Do you believe Capita can ever achieve net profits of over 200 million as they used to do a few years ago?
Shall we? I think we're going to get first started with where we are, right? I think we got a yardstick to get to 24, 25. We got to get to free cash flow positive. Hopefully, everybody would agree that once we get there, it's a different Capita. It doesn't mean that we don't have anything else to do, but that will give us the foundation to then go and say, okay, what's next? And then at that point, we'll come back with ideas and some commitments. I think it would be premature to say yes or no at this stage.
Okay, thank you. Got a question here on cash flows. The company's given pretty good guidance re operating margins and cost savings, but fairly limited guidance or explanation on cash flows. Can Adolfo please talk us through the main dynamics that impact operating cash flow, in particular, working capital dynamics, including deferred income?
We do have, so that one might just kill half the audience. Having sat through many of these discussions at the board and at the executive committee, there is a significant, we have to go back in, I think this maybe 7 years to start looking at the deferred income that was created with the introduction of the new accounting standard IFRS 15. Created a massive lump of deferred income that is finding its way through the P&L every year, and that we've been reducing. But if somebody wants to see the sort of more detailed version on the presentation that we did on the first half, team had a really good, I think it was reasonably detailed summary slides, and we can just make it available to people who have participated here with the voiceover. I think that's the most we've ever said about it, and the most that we can say, because it's a rather complex set of moving parts.
Okay, you may give a similar answer to this question, but it's related to the last one. can you explain whether 0.5 billion of deferred income on the balance sheet has been deployed?
In terms of where that's been deployed?
Yes, that is the question.
Yeah, so there's a few contracts that it's on. They're split across both divisions. They're largely older legacy contracts that I would say. So I wouldn't want to name them exactly where they sit, but they're some of our longer standing, bigger contracts that had a lot more transformation towards the beginning. Alex, not to deviate from your question, but in terms of building numbers, we have about 140 down from nearly 300 at the start of 2020. Hot off the
Brilliant.
press.
Okay.
Thank you, Stephanie. Thank you for that.
Well done.
That's very efficient. Here we have a next question. Will the relationships with hyperscalers help Capita win significant international business?
Yes, it will. As a fact, I'm on my way out tomorrow to Germany for exactly one big opportunity that we have there that includes hyperscalers, and these players play globally. They have the advantage of have what they call regions, sovereign regions in many jurisdictions. While operate globally, they can serve locally and they can provide pretty good solutions in terms of data residency. And yes, obviously, what we built with them here is totally relevant in other countries where we operate. So yes.
Thank you. Where do you see the remaining 60 million of costs coming from? Will the majority still be organisational simplification, or will there be other cost tracks do more of the heavy lifting?
It's going to be a mix. I think organisation still playing a role. I think we're working through different projects. Some of it has been sort of low-hanging fruit, as you're saying. But we got opportunity, for example, on the back office. I think there is right-shoring opportunities there. We've got opportunities on end-to-end processes in support functions, making sure that we get more automation and there is less people hand-carrying manual stuff from one another, which will also give us quality and agility improvements. So there's still going to be opportunities there. I think still in terms of management layers, there's still work to do there. So I think it's going to be a little bit harder. We're going to have to sort of speak more determined, but I think there is no way back, and do these changes in the organization and in the processes to deliver the 60 million or whatever we need to deliver beyond that.
Thank you. I'm conscious of time. I think we've got time for one last question. So apologies if we haven't been able to ask all the questions. We try to get through as many as we possibly can. Can you comment on the existing customer uptake of the new digital offering since they've been deployed? And do you have any comments on the new contracts with these customers?
Yeah, that's a good question. If I just sort of go the agent suite of products, which are full Gen AI, every customer that we have shown it to and demonstrated it, every single one of them wants to use it. Is as clear as that. Now there's the question of, okay, how do we go about this? That there is a data protection, is the data privacy, how do we do this? But when they see it, they say, I want that. And again, we only announced that 5 weeks ago. So very early days, but the support, the reception has been superb.
Brilliant, thank you. We are coming to the end of this webinar this afternoon. As you exit, you'll be asked to complete an exit survey. So we'd really appreciate it if you could spend a couple of moments completing that. And just before you go, I'm going to hand back to Adolfo just to say a couple of concluding remarks before we go.
What could I say beyond thank you? I think thank you for the support over this very tough few months and years. And I know this has been like very frustrating. Thank you for the time today, and thank you for the trust and the support to deliver this transformation. So just thank you.